just the sheer amount of stuff that's coming out of the IRS and Treasury over the past 6 to 9 months is just, you have to pay attention. Obviously, good job security for people like us, but we got to make sure that we're around it and we're on top of it because it is going to literally affect all of our clients.
Hello and welcome to another episode of Simply Tax. I feel like lately we've been running a continuous race of change and learning when it comes to accounting methods. These can seem and are often complex and very intimidating to many, including myself, but in its simplest form, an accounting method is just a set of rules used to determine when income and deductions are reported on a tax return. Now, there's no single method of accounting that's required for all taxpayers, and there were many changes to the accounting method world before it was ticketified under the Tax Cuts and Jobs Act, as guest Nathan Clark explained in episode 36 of the podcast. But there are two things that have remained constant. First, the method used by a taxpayer must clearly reflect income. And second, once a method has been established, the same rule must be used from year to year, and Section 446E requires IRS consent to change a method of accounting. To help us cut through the static and add a method to the madness, I'm excited to share with you today a conversation I had with two members of BKD's national tax team, Travis Butler and Brittany Cummings, on the changes to the accounting methods world. These two method men and women come to bring the accounting method pain hardcore from the tax brain to cover recent guidance in the areas of bonus depreciation, revenue recognition, negative Section 263A, lease accounting, and more.
Simply Tax.
All right, let's start with bonus depreciation. On September 13, 2019, Treasury and the IRS released final regulations under Section 168K related to bonus depreciation, along with newly proposed regulations. This seems like a fitting place to start our exploration into the accounting method abyss, since bonus depreciation was the first area that we received tax reform-related guidance on back in August of 2018. Let's rewind back to episode 38 and hear from frequent podcast guest Jesse Palmer with some background on bonus depreciation.
Bonus depreciation actually was really intended, I think, to be a temporary provision. This kind of dates back to September 11th in 2001, kind of in response to the 9/11 events and the downturn in the economy. As a result, it was meant to be kind of a stimulator to stimulate the economy. And back then, they provided a 30% bonus depreciation provision for new assets acquired, and then kind of over the years, and it was temporary as well, was scheduled to sunset. But then, as with many things that are added to the code that are tax, deductions or credits or so forth, it's really hard for Congress to let those things expire due to the politics and so forth. So, over the years, we've seen bonus being re-extended and the percentage being changed. So it went from 30% to 50%. And then for a period of time, it was at 100% and then back down to 50%. And as it stood before the Tax Cuts and Jobs Act, it was 50% scheduling to be phased down through 2019. This is nothing new, I guess I would say, but it's certainly something that's been around for well over a decade now. So that's, I guess, kind of the history of bonus depreciation. But really, it's meant to be kind of a way to stimulate the economy over the years, just, with the fact that you can write off, such a large portion of your fixed assets. That's, the intention is business owners will go out and buy new equipment or buy, property that could qualify for bonus and get an immediate tax deduction.
Here's Brittany on the latest guidance in this area.
So I think there were two kind of bonus releases for this year. The first one was in the August 2019 related to Rev Proc 2019-33 that kind of allowed taxpayers who may not have taken bonus on assets for as of September 17, 2017, to even if they took the bonus and wanted to elect out of the bonus, they could also elect out of it as well.
I think that one of the things, Damien you and I always kind of have sidebar conversations about this is that the IRS sometimes is not the best at timing when they release things. And so I think that this guidance was welcomed in the sense that a lot of taxpayers were doing things kind of guessing at the time of filing their returns, and getting some substantive guidance on what you could do, because I think a lot of people were worried. If you think back to the bonus depreciation over the years, it was kind of a non-revocable kind of election to elect bonus. You couldn't really do anything after you elected it. And the only way that you could kind of revoke it would be 9100 relief. And what they did within this revenue procedure is that they said, hey, well, listen, if you elected bonus, and let's say you elected 100% bonus, and you then determined that you wanted to elect 50%, under the old rules, you would not really be able to do that. You'd have to kind of go in for 9100 relief and justify and give a justifiable reason why you would be able to do that. Well, within this RevProc, they allow you kind of in your first, second, or third year return following your timely filed return to revoke, elect bonus depreciation. It relates to, again, property placed in service after that September 27, 2017 return. So I think it's good transitional guidance to try to follow up maybe the not so good timing of the release of the proposed regulations or the extension of bonus at the time of people filing their returns.
The biggest question I had with the limited amount of mental bandwidth that I had available when this latest round of guidance was released from Treasury was how it addressed the question of whether taxpayers can still take bonus depreciation on qualified improvement property, or QIP, after December 31, 2017, which is commonly referred to as the retail glitch created by the TICJA.
I guess I'm not sure if you learned much more. I think one of the things that everybody was waiting on, I think that you've kind of are familiar with it, is the whole technical corrections piece of the fixed asset P of TICJA, in the sense that they kind of wrote things wrong within the law. They were hoping when this guidance came out, here in mid to late 2019, that they would address that, but they didn't. I think what the main piece in this RevProc was really addressing the transitional guidance as it relates to the election for bonus. It didn't really kind of comment on additional property. I think the definition of the qualifying property was in there. I think that the timing, meaning what property qualified, when that placed in service date was, when the contract date was, if it was before or after that September, 26th, 27th timeframe. Within this RevProc we're specifically talking about, I think the number one thing it addressed was the ability to revoke the election and that sort of thing.
Okay, so as Travis just told us, and perhaps not surprisingly, Treasury provided in this latest round of guidance that the statute as amended by the TICJA does not classify QIP as having a recovery period of 20 years or less, and confirms a legislative change must be enacted to allow bonus depreciation. In the guidance, Treasury also declined to adopt comments requesting that the IRS not challenge or audit taxpayers that treat QIP placed in service after December 31, 2017 as eligible for bonus. So, where does that leave us? And what's next?
I guess from what I'm hearing, all secondhand, no firsthand kind of thing, is that obviously there's a lot of taxpayers, if we're specifically talking about the error piece, there are a lot of taxpayers that obviously want the definition for qualifying property to include qualified leasehold improvements, but it's not as simple as them just kind of sending out a email and saying, hey, we can include this stuff. So a lot of stuff has to happen, out there in DC for this to happen. And kind of what I've heard is that they want it to happen. It's just now a matter of if it's going to happen, if it's going to take precedence. I think as we continue to talk, there are a lot of other things that they're working through out there, and that this might be just one that's just not maybe going to be corrected. But at this point, nothing's been, released. And so here we are filing our last set of tax returns for calendar year and taxpayers. And so the only thing we could hope for is that by the time we get into busy season next year, maybe there is a technical corrections bill. Again, there is a bill, but just maybe there's now, additional guidance that allows us to expand that definition to that. I think that, in my opinion, is probably the most talked about piece as it relates to fixed assets from the TICJA stuff.
In the newly proposed regulations, Treasury also specifically addressed the question of whether an auto dealer with floor plan interest can still take bonus depreciation on fixed assets if the floor plan interest adjustment was not needed to fully deduct interest expense under Section 163J. The proposed regs provide that bonus depreciation should still be available in this situation and state that it is evaluated annually. So even if a taxpayer did not take floor plan financing into account to deduct interest expense in year 1, it can still take bonus depreciation on additions in year 2 if the floor plan financing was not used to deduct interest expense in year 2. Now, bonus depreciation is just one aspect of the accounting method madness relating to fixed assets that we've seen and heard headlines swirling on. Here's a few more.
I'm also hearing a little bit of talk around what is actually still eligible for bonus, or if assets qualify for bonus under 163J in relation to guilty. A little bit of talk on that, and just clarifying for 163J if the asset is related to the floor plan interest, if those assets can be still treated as assets that qualify for 168K.
You bring up guilty. And so one of the things that I was going to talk about from a methods perspective is that this kind of like give and take as it relates to methods associated with foreign companies, whether they're CFCs or branches or, foreign partnerships or whatever. When the transition tax came out, the IRS came back and said, hey, absolutely not. You cannot do method changes for things that are going to result in a favorable 481A adjustment, because then it would reduce the amount of transition tax you would have. Now, you could still file the method change and they would accept the method, but they wouldn't accept the adjustment. And so everybody's like, oh, well, let's hold off on doing method changes associated with our CFCs and our foreign branches for right now. But then guilty comes out, and for purposes of your tested income, you can, and they actually do specifically talk about things related around depreciation, that it actually is a method change if you want to switch from whatever you're doing to an ADS kind of a method for guilty purposes. So I think it's kind of interesting that, we're kind of going back and forth from a standpoint of our foreign entities and what our kind of our opportunity is in terms of filing method changes associated with, obviously, not just fixed assets and depreciation, but anything else.
Comes up in the 451 regs as well for foreign
right.
entities, and kind of in the proposed regs what to do next. But
yeah, and I think lastly, before moving on from fixed assets, I think the other thing maybe we've seen in the marketplace, or what I've seen, is the placed in service rule as it relates to what they came out with the guidance. And that was, before it had to be new property, right? And now it actually says in the guidance that it can be, quote unquote, used property. It doesn't have to be original use property. That's a pretty big deal when you're dealing with companies that are acquiring things. You still have to worry about the contract dates and that sort of thing, and when you place things in a service. But from an original use perspective, that was always like, hey, if it's not original use asset for a taxpayer, you cannot take bonus on it. And now you're able to do that.
Before we leave bonus depreciation and fixed assets to explore other exciting areas of the accounting method world, here's a closing thought from Travis on cost segregation studies in light of all of this change, which can help a taxpayer accelerate depreciation deductions through savings embedded in real estate holdings.
I have a background. I spent a little bit of time back in my day at a former firm doing cost segregation studies, so they're always kind of near and dear to my heart. I always will recommend them, because it kind of seems to me, if I'm kind of sitting on the other end and I'm the tax director or CFO, it's kind of like free money to me. I mean, I know it's timing, but it's kind of free money in the sense that these rules are not substantially complex, and it's pretty easy to identify, costs and things that you do within any sort of type of building to carve it out into a shorter life. And I think it's even more relevant now, maybe in certain industries, maybe more than others, but like especially those industries that were focused on the qualified improvements. Now those qualified improvements, they used to be 15-year. Now they're 39-year. And so the only way that we have the ability to kind of get that bonus depreciation, but also a better life, is to do cost seg.
All right, let's change method gears here and give some recognition to another area that's been contributing to the accounting method madness.
Obviously another hot topic, as we just were talking about, is revenue recognition. I think it's one of the things that maybe has been punted down the road a little bit, in terms of maybe we haven't seen it as much because it's just been public companies that have been really required to do it via ESC 606, which was required for public companies for their 2018 year. But for private companies, it will be applicable for 2019. And that's even more relevant in the sense that we just got recent proposed guidance that came out on September 5th regarding 451. And so within 451, it talks about how you're going to recognize things. And the reason that's important is because as we kind of dive into these details, and again, can go down that rabbit hole, is in 451B, in the new regs, they've clarified that it used to be that you would recognize revenue to the extent that book did. And then you would have the ability to defer under two avenues. You would have revenue procedure 2004-34, which you would have a 1-year deferral. Then you would have 451-5 for things of goods or inventoriable type goods that could potentially give you a 2-year deferral, even maybe longer than that. You guys probably remember the whole kind of gift card world and gift card companies and that sort of thing. That was the whole realm of that. Well, now, with the proposed regulations and how 451B, it basically says that you have to recognize for tax, you have to recognize revenue to the extent that books does. And if they don't, and let's say that books is deferring, you still have the ability of 2004-34 for now, and you can rely on that guidance because, again, the guidance that we have now is proposed. You can use it as guidance. You can rely on it, but you don't have to. It's not like it's final guidance right now. So, a couple sort of situations there, right? So, if we think about a company that's implementing ASC 606, and they go through their implementation, and it's determined that we are going to accelerate revenue. And for book purposes, they come up with an adjustment, but that adjustment is not material for book purposes. Presumably, they would run it through prior year retained earnings. The issue with that, if you think about it and kind of talking to clients about this, not the people, that understand this, is that, well, that revenue hasn't been taxed. And so we have to find a mechanism at which to tax that. And so that mechanism is a method change. And so we would file a method change. And let's say that that's what it was, is that books change their revenue rec. We're going to follow it for tax. We agree that it meets the definition of 451 and it should be accelerated because it is being picked up for book. We would then file that method change. We would have an adjustment, as we all know, that probably the people listening to this podcast would be, there's the general rule and there's all sorts of exceptions to the general rule. But generally, we would pick up that adjustment that books had run through prior year retained earnings, spread that over 4 years. And then going forward, if we agreed that tax would follow book, we would have no book to tax difference as it relates to that. So that's pretty, if you think about that, that could affect a lot of companies, a lot of private companies. I think it's going to be industry specific. I think there are going to be certain industries where it doesn't affect them at all. You would then have to just go down that path of determining if you still need to file a method change. Our position here at BKD is that giving that exact same fact pattern, let's say that there was no adjustment, but they went through the implementation process. They analyzed their performance obligations. They broke down their contracts now down into 3 or 4 different performance obligations. They allocated their transaction price differently, all these different things. Our recommendation would be that there would still be, at this point today, kind of a protective 3115 that you would file, similar to the tangible property regs that we did back in whatever years those were, where you basically, if you think about the tangible property regs, we filed a method change to say that we're now looking at the building differently. We're looking at it, instead of one building, we're looking at the 9 building structural components and that sort of thing. It's the same kind of concept and where we're at here at BKD with that. So if you think about that, you have a company that's private that goes through it, ASC 606, has an adjustment, there's a method change. You have a private company that goes through ASC 606 with no adjustment, there's a method change. So I think that there's going to be potentially a lot of method changes being filed in 2019 as it relates to revenue rec.
I also think you maybe had a few, right, that for private companies that would have early adopted unknowingly that it would change the taxable income because there was no adjustment to income or adjustment to retained earnings. So there would be maybe a few, but I think more in 19, as you're saying.
Yeah, and that's a good point. As we talked about, ASC 606 was applicable for public companies in 2018, but companies could early adopt, private companies could early adopt in 2018. So, again, we have ASC 606. It's been around for a while. We have these new proposed regulations that talk about what we're going to do as it relates to now these changes that are going to be coming through the pipeline related to ASC 606. The proposed regs are 451-3 and -8. -3 we kind of talked about. That's the AFS income inclusion. -8 is really talking about advance payments. And so there's another kind of little twist with advance payments too. If you recall, a few minutes ago we were talking about is that companies did have the ability to use 2 mechanisms. They had 2004-34, 1-year deferral, and they had 451-5 for the 2+ year. That's now gone. It's like nullified. I don't know what the right technical term is. Do you know?
Removed,
disappeared,
disappeared,
gone.
Yeah, gone.
But anyway, it's gone. So So let's use that example. Let's say you have a company that was previously using 451-5. What they would have to do is they would have to do a method change to either go to 2004-34, go to full inclusion, which is another opportunity because the IRS always allows that, right?
Yep.
They allow you to pick up all the revenue in year one. They won't tell you not to do that. Or you can go to -8, the -8 proposed regs, which is the advance payment deferral election within those proposed regulations that came out. Again, they are proposed, but you have the ability to rely on them. So for those companies, there is going to be, again, another method change. For companies that have advance payments and they're utilizing 2004-34 and they want to keep doing that, to the extent the books hasn't picked it up, you can continue to rely on it, no big deal. You can elect the advance payment, deferral election if you want to go from 2004-34, but it looks and smells and feels the exact same. And there's different rules for companies that have applicable financial statements and non-applicable or don't have applicable financial statements. But again, I don't know how far we want to go down that rabbit hole. So there's a lot on the docket as it relates to revenue rec. And then there are nuanced things. You have the banking industry has its own kind of little bit kind of things going on. I think there are going to be certain industries that are affected by this more than others. I think that software
technology companies,
companies are going to be
Yep.
extremely affected by this, but your typical manufacturer who has one or two contracts, probably not. So I think that there's a lot to be talked about here in the upcoming year-end planning season. I think that this is one of those year-end planning seasons where it has to be a coordinated approach
Right.
between audit and tax.
Yep.
Whether it's the same firm. So, for example, BKD is the audit and tax firm. Pretty straightforward. We're obviously going to do that, but it also is going to be we're their tax provider. We're going to have conversations with those audit folks to say, hey, what's going on with your audit memos and the implementation of AS 606? Because I'm not sure, Damien, if you've read some of these memos, but they're not short, pretty long. So I think there's a lot of, in our world, we would call it exciting stuff. For other people, it might not be exciting, but it's definitely a lot of exciting, interesting stuff.
Much like with the bonus depreciation guidance that we received last month, I had a few key areas that my overwhelmed tax brain was particularly interested in when the Section 451 guidance came out, and that's cost of goods sold and variable consideration.
Yeah, there's a couple interesting things I think that were addressed in the proposed regulations that everybody had questions on. And so what companies were asking for was, hey, to the extent that I need to accelerate this revenue, I'm going to bring in kind of the pro rata share of cost of goods sold or expenses to offset that. And from a tax perspective, now from a book perspective, they can do that. I again, not a GAAP person, but let's say that they do that. We're still on the tax side. We're still governed by 461. And so if we're not meeting the definition and the requirements of 461 to be able to take a deduction, we're not able to take that deduction. And so we wanted guidance, or companies wanted guidance to say that, yeah, you can have this if this is the reason why, even if it doesn't meet 461. I think that's what they were looking for. They clarified in the proposed regulations that at this point, there is no cost of goods sold offset. I think the other thing that they truly honed in on is variable consideration and contingent consideration. That's a situation when these regs first came out, or the situation with ASC 606 came out, and they brought out the first kind of method change that they were going to do to kind of implement this on the tax side. Everybody was reading it literally in the sense that, hey, if Books is picking it up, regardless of what it is, you have to pick it up for tax. And so then providers and companies would say, well, what if it relates to variable consideration or contingent consideration? And that's a situation where, let's say, Brittany and I have to do something in the future in order to earn that revenue. Why do we have to pick it up for tax? And in these proposed regulations, they clarified that it does not trump the realization event or the all events test. So if we have those situations, again, so what you think about that is that now we have that two-step process where we say, okay, well, to the extent it's recognized for book, we're going to pick it up, but I can't just say all of it, because now I have to analyze that revenue and say, is there stuff in that revenue that actually can defer for tax, not under 2004-34, but just under the fact that it hasn't met all events. So those are the two things, I think, another two big areas that they kind of confirmed in these proposed regulations that came out. And I think it does address, it's one's pro, one's not so pro, or a con. If you think about it, and I don't know, Damien, if you've ever recalled this, and Brittany can chime in too, I don't think I've ever recalled where we've had to overly analyze revenue streams from a tax perspective, where we have to look into the contracts for tax to determine, hey, books is going to recognize this, but now I might not have to for tax, or books is, going to accelerate it, but then they're going to defer some of it. But how long are they going to defer it? And then am I going to defer it for tax? So I think it's one of those new things that we're going to have to it's going to be a culture change and built into our yearly thing, because companies are always going to change their contracts. They're going to have new revenue streams potentially. And so every year as tax providers, we're going to have to get into, hey, analyzing their revenue streams to determine if we meet the requirements under 451 and when we're going to have to recognize that income for tax. We're not just going to be able to say we're following book. Or if we do that, it's not that we're out of line. It would just might not be doing a service to our clients, and that they might have the ability to defer some of that.
So now that you know about this guidance, you might be wondering what some best practices are for addressing it.
I think especially now for private companies is starting the conversations now as we get ready to move into tax planning, but the audit team is already in their audit planning stages here near the end of the year. So I think being ahead of those planning meetings and making sure that our tax teams are involved and starting earlier rather than later is going to be the best practice. We hear it all the time, but we also just haven't been under this huge amount of change that we have going on with the proposed regs and due to TICCHA. And so with that, we just have to be more proactive in reaching out to our audit teams, both internal and external, from a tax perspective.
See what I mean by accounting method madness? There's a lot that we've discussed so far, and we haven't even started talking about the negative Section 263A guidance yet. Before we do, let's get Travis's 2 steps for approaching the guidance changes that we've discussed so far. Travis, would you agree that there's been a lot of change lately?
Yeah, there's a lot. What about if you have companies that they timely filed, and so they missed out on all the tax reform stuff? So that's, step one. Like, did you miss the low-hanging fruit where you can, you're under the 25 million, you could switch into cash, you can get them exempt from 263A, maybe even the inventory method change that's out there. So that's step one. Step two is what we just talked about, is addressing revenue recognition, because it is now applicable for our 2019 tax year. And then right after that, perfect timing, right? In November of 2018, the IRS released, we're calling them the negative 263A regulations, or the new UNICAP regulations. And they kind of just went silent because of everything else that was going on with tax reform and revenue rec. And we haven't really addressed. Plus, the applicability of them is not until 2019. So we didn't really talk a lot about it for their 2018 tax return, because there were so many other things to talk to them about, with not only just from a federal perspective, but all the other things that we have seen in the tax returns that we do in Section 199A and GILTI and FDII and all these wonderful acronyms we love to use. We have these negative 263A regs, which is going to change the landscape as it relates to companies doing their Section 263A calcs. That's number one for, especially, predominantly here in the Midwest. We have a lot of manufacturing clients that these new regulations, I will tell you, I'm pretty confident in saying that one way or another, they will affect 99.9% of manufacturing clients. And the reason I say that is that there's probably 5 or 6 main bullet points within the regulations that maybe a company does 3 of them or 4 of them the right way, or the correct way, or an acceptable way, but maybe not doing them an acceptable way for the other 2 or 3. If you're not doing them acceptable for just one, it would be a method change for them to do. And so within these regulations, again, they were released in November of 2018. They're applicable for companies for any tax year that begins on or after 1/1/2019. And they're called the negative 263A regs is because they were in proposed format for probably 7 or 8 years. And in my experience, this was by no means a national experience level, but my experience level was that a lot of UNICAP calcs weren't audited that much. And I think that my best guess, I don't have any insider information, was that the reason is because this proposed guidance was out there. And so maybe there was a directive where IRS agents weren't supposed to look at it because maybe these regs were going to go final, and then there would be a method change anyway. Well, now they're final, so I could just presume that now that we have final guidance, and these are not, again, if you go back to revenue rec, those are proposed. These are final, so we have to rely on them. And so there are, I would say, 4 or 5 big ticket items in there. And again, starting with why they're called negative, is that presumably you have companies that are going to be on 1 or 3 methods. And I'm not going to try to go down the rabbit hole with Unicap here, but because we will lose people fast. But you could be on a facts and circumstances method. You could be on a simplified production method if you're a producer, or you could be on a simplified resale method if you're a reseller. Well, they came up with a new method. It's called the modified simplified production method. So let's just focus on that bucket for a second, is that if you had a company that was on the simplified production method and was considering costs that were capitalized for book that you didn't need to capitalize for tax, i.e. a negative adjustment, things like R&D costs. They were capitalized for book, don't need to be capitalized for tax. We would run through a negative adjustment most times in the numerator of our formula, not to bore people on the podcast. But that's the whole reason they addressed this, is because the IRS felt that distorted your absorption ratio. And therefore, now you have very specific guidelines on how and when you can use negative adjustments. You have to be either on the modified simplified method, you got to be a small taxpayer, or you have to use the simplified resale method. So there's that big thing in there. And then there's other small things, like they changed the definition or refined the definition of Section 471 costs. And so if you have a company that doesn't, and so 471 said another way is kind of what most people would think that of what you capitalize for book purposes. So maybe they didn't include everything that they should have for book purposes. So they're not capitalizing 471 costs. That's a problem now. You have to capitalize those. And so now how do you capitalize those? Do you fall underneath this new method? Other things is there's changes as it relates to how you allocate mixed service costs under this new method. There are things related to if you have companies that don't capitalize all of their direct labor costs. That's a situation where you have a company that maybe doesn't capitalize things like holiday pay and sick pay and all those things associated with people that are directly related to the production process. It just seemed immaterial at the time. Well, you have to meet this now new de minimis rule. If you don't do that, then it's a method change. You have other things. Same goes with there's a de minimis cost for direct materials. And then lastly, there's a couple other nuances. What's your treatment of freight? What's your treatment of over and under variances and burdens? All these terms that are probably familiar with people in the manufacturing world, maybe not familiar with people in the banking world. But for my true manufacturers and even my resellers to some extent, but not that 99.9% bucket, they're going to be affected by this, because I think, as we can all attest to, is that not many people like to spend time on Unicap. And so how many times have we heard is, oh, that's been our method for 15 years. Or, hey, it's the same percentage as last year. The good old Sally line, which we all love. Well, we can't do that anymore. So I think that's my number. Besides revenue rec, which I would say is 1A, I would say the negative 263A regs is 1B. I don't know if you want to add anything on those two.
I think the only thing is I kind of reverse and say negative 263A maybe a little 1A, and revenue recognition is 1B.
Yeah, and I mean, going down the planning list, I think that then if you talk about other planning, I mean, cost seg and fixed asset review is always going to be on the table. I think that's always going to be something that we look at. I think inventory for me, it's kind of maybe a world that I live in a little bit more in terms of company evaluating whether they should, stay on LIFO. Maybe they come off LIFO. Maybe the benefit isn't there anymore, or it's companies that now have historically been on FIFO and want to go to LIFO. That's always something that's out there. And then your other, miscellaneous ones that we've always kind of heard about. I think, prepaids is still always the good old prepaid one is always out there. There are a couple risk ones. The accrued bonus thing is still an issue. And this is the situation a handful of years ago where the IRS had deemed bonuses not to be fixed and determinable if the amount of the bonus was paid to somebody that wasn't there anymore, and it reverted back to the company. So therefore, if you just, again, talking in layman terms, if it's not fixed and determinable, you can't even use the 2.5 month rule. And so if we've been inadvertently doing that and the bonus plan reads that way, that's a risk area for a client. And then lastly, again, here in the Midwest, dealing with multiple locations, big facilities is rents and Section 467 rents. Again, that's an issue where companies, for book purposes, what they'll do is say you have one lease 10 years, they'll, for book purposes, amortize the lease payments. If you have escalating rents, they'll kind of pull in all those escalations and just do it divided by 10. And so if you think about it, in the earlier years, you're going to be taking a book deduction higher than what you've actually paid out in cash. And so now, obviously, tax would come in and say, hey, that's a no-no. You can't do that. And so it's governed by Section 467. That's a method change. And depending on where you are in your rental cycle and how many locations, that could be a little bit burdensome tracking that, as well as whether it's going to be favorable or unfavorable. So those are what's on my mind. I don't know, Brittany, if you have any other ones.
I mean, I'll stick on leases. You have the ASC, is it 842?
842.
842 for leases. I think they have a postponement for some companies. As Travis was mentioning, it's kind of in line with the revenue recognition rules, where we have to dive a little deeper into leases, similar to how we have to dive in deeper with revenue recognition. So companies with those leases and how leases are treated from a book perspective will need to analyze from a tax perspective, not necessarily meaning that it's a change, because the way that you view leases from a tax perspective doesn't change, but you just need to make sure your recognition is in line based on the changes from a book perspective.
Yeah, I would agree with that. I mean, I think that just trying to stay ahead of the curve. I
Right.
mean, even though we have a delay in ASC 842, which thinks it's going to be, instead of 2021, maybe it's now 2022 for private companies, it's not going to have the impact that ASC 606 did.
Right.
But it gives us the ability, because again, when's the last time any of us had said, hey, I reviewed the lease and I've confirmed that it should be treated as an ordinary lease or a finance lease versus a capital lease or whatever. I think that that's the thing. Also, I had this come up where we were analyzing leases and there was an embedded lease within
Yes.
an overall lease. And so there's different treatment for that. It gives us the ability to review the leases to determine if there is a method change. Again, if nothing changes for tax, meaning that there's no new leases, we agree that it's the same thing that it was before, there won't be a method change. All that's going to do is going to be a presentational change on the balance sheet. Now, the issue with that is that, just to kind of warn people, is that the reason that it's important is that there might be a different way of doing your book to tax. If you have a lease that has what I just talked about in Section 467, and you've historically taken deferred rent as your change in balance, and that's your book to tax difference, let's just say that's that. Well, that deferred rent account might go away. It's going to go into the right of the use asset, and it's going to be offset. So your book to tax is going to be the same, but the way to calculate it would be a little bit differently. So I think we haven't seen that yet, and at least I haven't seen it yet in terms of the presentation and how it's going to flow. But I just think it's one of those things to say, hey, let's stay out of the curve. If we're reviewing leases for book, going back to that coordinated approach, we should be reviewing them for tax just to ensure that we're capturing them correctly for tax purposes.
Let's wrap up our Method to the Madness discussion with my favorite question that I like to ask when talking to an accounting method man or woman, and that's what their favorite accounting method is.
I actually couldn't narrow mine down. What I found was a theme, though. Any accounting method that was related to revenue recognition or the treatment of revenue. So, of course, 451, Travis hit on it earlier. In our world, it's exciting. I think it's intense and it's a lot, but it's exciting. Damien, you mentioned early how important it is to the national office team to make sure we start to really have that audit and tax team collaboration. And this is another one of those perfect opportunities to introduce that. And I think anytime we're speaking about revenue recognition, you always have that opportunity. So definitely anything around revenue recognition, have to be specific. Those are accounting methods 231 and or 239.
Not that it's a competition or anything, but here's Travis's favorite.
It definitely is a competition. Cost segregation and fixed assets always going to be kind of near and dear to my heart because I used to do it. And, I actually did the grunt work behind the actual adjustment and analyzed the buildings and looked at blueprints and did all that sort of stuff. So that one, but then I think you guys know it. And I think that maybe more people in the firm are kind of noticing. I've spent a lot of time on Unicap. And it's not that maybe it's my favorite, but I do know that there's a lot of things that I could bring to the table to correct, fix, make more efficient for a client, or limit the amount of headaches that a client would have in order to kind of be in compliance with UNICAP. And I feel I bring a common sense approach to it. So I think it's, again, not my favorite, but something that I spend a lot of time on and comfortable with, and I think can bring a little bit of a different approach.
Okay, well, Travis and Brittany both clearly cheated here, but I guess I can't say that I blame them. I mean, there are a lot of great accounting methods out there, and we've covered a lot of ground with several of the hot topic ones today. Let's go ahead and use the cutoff method for our accounting method conversation for now. But before we do, here's one last thing on the topic of collaboration from our METHOD man.
We're talking about coordinated approach with audit and tax, but I think I would be remiss if I didn't say that we still have to be coordinated with our specialty tax groups, because this revenue rec, for example, I just did a revenue recognition method change, and we had to disclose the adjustment associated with their CFCs on this method change. So if you think about that, historically we'd say, okay, well, there's no sort of an event, quote unquote event, and we're not going to go down the rabbit hole, but there's no sort of event on the international side. So therefore I'm not going to kind of think about my changes that I'm going to have from a federal tax perspective, because it's just going to go through E&P and I don't really care, or there's no effect. Well, now I got to think about that. And so then I also have to think about, are there state issues as it relates to revenue rec? Is there issues with sales apportionment? Is there issues with property tax? Is there issues with, again, like I said, international side? Is there issues with transfer pricing? All these different layers that we not only need to be coordinated with audit on, but we need to be coordinated with our specialty tax services to talk to them and say, hey, listen, we had this adjustment. Do we need to think about anything from a standpoint of all those areas I mentioned? So I think it's overall coordinated approach as it relates to some of these methods. So just wanted to put that in there. I wanted to make sure that I call out my international colleagues and state colleagues. So
That's it for today, but please take the opportunity to learn more about accounting methods in ways that Travis, Brittany, and BKD can help in the show notes of this episode, available at bkd.com/simplytax. You can learn more about me out on Twitter, where I tweet about tax at Damien Martin CPA, on Instagram, where I post about my life at the intersection of tax and being a dad at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.